Hello, I'm Russell Poynton from Edison Group. Today it's great to have Christoph Barchewitz, the CEO of Global Fashion Group, with us to talk about the company. Hello, Christoph. Thank you for coming.
Thanks for having me.
So, most people probably unfamiliar with the Global Fashion Group story. So let's start off with talking about what the company does, talk about the opportunity.
Yes. So we are a fashion e-commerce business. I think for many of the Europeans, Zalando is probably the read across that will explain the business model in the most easy way. We've been around for about 13, 14 years, initially launched in Brazil and then expanded to a number of markets. We're today present across 3 regions with 3 different distinct consumer brands. So we have the Iconic in Australia and New Zealand, which is our biggest business, just under 50% of our sales last year. We then have Dafiti in Latin America, which is today Brazil and Colombia, which is about a quarter of our sales. And then we have Zalora in Southeast Asia, which is another quarter of the overall business. And within our business model, we really have 3 components. We have what we call the retail business, where we take inventory risk in the more traditional wholesale fashion model. We then have the marketplace business where brands are bringing their inventory to our platform and directly selling to customers. And then we have the third line, which is platform services, where we are effectively monetizing our capabilities across fulfillment, marketing, and also data, serving our brand partners in reaching customers on the digital channel, supporting brand.coms, enabling them to engage with the digital consumer in our markets, which are growth markets for most global brands.
Well, that's great. Could you just talk about the size of the market opportunity and why you think you're so well placed to win in those markets?
Yeah, I think that's really the exciting part because we serve a huge number of people in these markets. There's actually about 750 million people living across the markets where we are present. And within that, we obviously can't service everyone and address everyone. There's a good part of the population, especially in the lower income countries, that is not currently buying branded fashion products. But we think about 150 million or so target consumers are actually relevant to us. We have the ambition of really targeting most of the customers in Australia and New Zealand, so probably 80% we would call target customers. But in the other markets, it's probably more 20% of the population. What is also exciting about our markets is that they're in an earlier stage of penetration when it comes to the shift from physical retail to digital. COVID has acted as an accelerator to that, and there's been a lot of volatility over the last couple of years. But what is now really materialized is that we're getting to that, high teens, 20% level of penetration across the markets. Australia is more similar to, let's say, the UK market or European markets, but then markets like Indonesia, Malaysia, Philippines, or Brazil and Colombia are still at a much lower level of penetration. So that's where we see a lot of opportunity. Today, we have just under 8 million active customers, so consumers who've shopped with us in the last 12 months. So we're still just scratching the surface, and we think there's a very long runway of further shift from physical retail to digital, in which we can kind of capture growth over time.
And you have quite a good market position in terms of your infrastructure and the relationships with the brands. So could you just talk about those and also perhaps a bit more detail on the retail versus marketplace and the different types of fulfillment you do for those businesses?
Absolutely. So clearly in our markets, we are effectively creating the bridge or the platform connecting consumers to brand partners. And so a big part of our strategy is really not just thinking about one of the 2 sides of that equation, but both of them. So on the consumer side, this is all about how do we bring the most relevant assortment in the best channel, which is primarily through the app, with the best content, the best curation, with the best marketing, and then also the best shopping experience on the app, but also afterwards when it comes to delivery and all those components. So that's the consumer side. And on the brand partner side, it's really about how we enable brands to reach new customer segments where many global brands in many of these earlier stage markets don't today have the full level of own stores, digital capabilities, etc. So That's much more of a growth opportunity for the brands there. In terms of the business models, I mentioned retail, marketplace, and platform services. I think the one that's really interesting is marketplace, which currently accounts for about 40% of our business. Within marketplace, we don't own the inventory, but we hold a good part of the inventory in our fulfillment centers. And what that enables us to do is to make sure that the delivery experience for the customer is as good as possible. So customer can't really tell the difference whether an item that they purchase comes out of the retail business model or out of the marketplace model when we are using our what we call fulfilled by solutions, where the stock is coming from our fulfillment center. And we've gradually launched those different fulfillment options for marketplace in our different regions. And today we effectively operate both the fulfilled by as well as the drop shipping, where brands ship directly to the customer. And then we have an in-between solution, which we call cross-docking, where the inventory flows through our warehouse, but only after the customer has ordered it. And so it's a more on-demand model where we then consolidate the order in our fulfillment center.
Well, thank you. That's good background in terms of the operations and the market opportunity. Could you talk about the competitive environment, because they're quite different markets that you operate in?
Yeah. Firstly, I think what is important is that we're really the only multi-brand fashion e-commerce platform in our markets. So we are the market leader in all the markets where we operate. When we look at that more somewhat narrow definition of multi-brand and only digital, we do have competition. Obviously, offline and physical retail remains a competitor. We have no intentions of playing in that, but that is still relevant for the customer choice of, do I go to a mall, do I go to a store, or do I buy on an app? Within the digital space, we really have two types of competitors in all markets. They're different companies depending on what country you look at, but their business models are fairly similar. On the one hand, we have what we call the general merchandise platforms. So these are players like an Amazon in Australia, and Mercado Libre in Brazil, or a Shopee in Southeast Asia. What they do is they offer everything to the customer. So they offer electronics, they offer FMCG products, they offer apparel. So they're really the everything store for the customer. And we believe that fashion, as a very emotional, branded category, has its limitations within those general merchandisers. And that's where we come in, where we can really tailor our experience when you think about sizing, when you think about returns, when you think about telling the story that is behind these brands much better to the customer by being a vertically focused player only operating in fashion, sports, and lifestyle. When it comes to the second group of competitors, it's really more partners and competitors, I would say, because it's ultimately the digital channel of the brands themselves. Many of the biggest global brands now have e-commerce platforms, e-commerce stores in many of our markets. Still not all of them, but it has definitely progressed. And certainly there also the pandemic has been accelerating the investments and the efforts brands have put into that. So we are competing to some degree for customer attention with the brand.com sites. At the same time, we actually believe it's a win-win, because the more presence a brand has in the digital space, the more digital and online shoppers are focused on buying that brand online. And that ultimately also helps us. So what we usually see is when we are in sync with what the brands are doing on their .com and what we're offering on our platform, that actually helps both of us. And we have some great partners, like, for example, H&M in Southeast Asia, where we enable all of their fulfillment for both the brand.com and sales on Zalora from one warehouse and one stock pool. And that really maximizes both the sales opportunity for the brands, but it also really helps to manage profitability, because it's one decision maker for pricing for the entire market of that brand.
Okay, thank you. Shall we start diving into the individual regions? So Australia and New Zealand would be a good place to start, as you've already mentioned, is the largest business. Could you just talk about the business, the customer profile, the changes you've made there over the last couple of years to help improve the financial position, the offer, that sort of thing?
Yeah, I think our business in Australia and New Zealand is really the core of the group, given that it's 50% of our overall business, but more importantly, it's the most profitable part. So last year, we were already at a 5% adjusted EBITDA margin in the region. We definitely have the expectation that we can go beyond that in the future. And what it really does there is we have a very unique position in the market as the largest player. combining a lot of the Australian brands that Australians love and that are deeply local to the customer with the best global brands. And so we've really built this assortment which brings together at very different price points. So from entry price fashion, some people would call it more fast fashion, all the way through premium and into entry luxury, a very broad range of customer needs from price point perspective, and then also from a category perspective. We're quite wide in terms of, we have strong sports offering, we have a strong women's apparel offering, we have a strong men's business. We're building out the designer and premium and luxury further. We have a good accessories business, and we also complement it a little bit with beauty. So we have a really broad offering. That broad offering is really important to drive relevance to many, many consumers, high percentage of the population in a relatively small country. And secondly, to enable higher order frequency. So actually, the Australian market has our highest order frequency across the group, function of the maturity, but also function of the breadth of the offer. Our home in Australia is Sydney. So Sydney and the metro area around Sydney has been the core of what we're doing, and our delivery proposition there has been a big differentiator. We offer even a 3-hour delivery in Sydney. So for any fashion emergencies, we can service customers. And we've recently invested into upgrading our capabilities in our fulfillment center, driving efficiencies, but also driving a better customer experience and broader services to the brand partners. And just earlier this year, we've really put a focus in replicating our success in Sydney, in Melbourne, as the second most important center in Australia, by accelerating delivery to that region, and that has had an immediate impact. So we're very confident with the position that we have in Australia as a market leader. We think there's still a lot of runway in building out what we're doing, but we want to do that and combine the growth that we've seen over the last couple of quarters with continued improvements in profitability and also generating cash. So overall, biggest part of the group, significant enabler of value creation, being already profitable, still having a big growth opportunity ahead, generating cash, and therefore really a fantastic business we're very excited about.
It's great. Let's jump straight into Latin America then, because a bit like Australia, there have been lots of changes in Australia and New Zealand, and you've made lots of changes in Latin America over the last couple of years, and which is showing improving results. Mm-hmm. Again, just talk about what you're doing there, the opportunity.
So I think in Latin America, we've really had a very interesting evolution of the business over the last 10, 12 years since we started. Today, we're focused on Brazil and Colombia as our two key markets. Brazil is really the biggest part of the business, so I'll mainly speak about Brazil for that matter. And what we've seen there over the last couple of years is that we've gone from a market that was a low penetration market with relatively few players to a higher penetration market, so very positive development, but also a much more crowded field of competitors. And so we've had the entry of multiple cross-border fashion and general merchandise players who've also for some time been taking advantage of some tax loopholes, let's say. Those have been partially closed now, so it's much more of a level playing field. And I think that external environment is an important factor in the evolution of the business. We are now at a stage where we are solidly growing again in the region. We have a very strong assortment. Our gross margin is very healthy. I think where we have further opportunity to really get the business back into profitability and get to that ultimate objective of a high growth but profitable and cash generative business is by really building up scale to utilize our infrastructure, mainly on the fulfillment center side, where we currently have a very large automated fulfillment center that is underutilized in Brazil, but also when it comes to technology and other fixed costs. We're just a bit too small today to really generate that sustained level of profitability. And so the last few years, we've made a lot of changes. We've brought costs down substantially wherever we could. We've improved the offering for the customer in many ways. We've launched a new app. We've really reset our marketing approach. So across the business, there's been a lot of changes in the last 2 to 3 years. And we feel very confident where we are now that we have a lot more of the basics in place for this next phase of the business to really grow and succeed. And also, we're integrated the Colombian business more strongly with the Brazilian business in the sense that it's now all under one leadership structure with many of the activities, such as marketing, such as technology, centralized from Brazil. And then, Colombia really run mainly commercially and operationally separately, but with the other activities all centralized into Brazil.
And so completing the set, the third region is Southeast Asia, where I think it's safe to say that you're probably not as far into the journey in terms of getting the offer quite right and then getting, improving the profitability. So could you talk about what you're doing in Southeast Asia?
Yeah. So I think what we've done in Southeast Asia is really we pushed this strategy of becoming a platform very, very strongly. And when you look at those metrics, it's actually the region that is the most progressed. So the indicators for that is we have about 50% of our business coming from marketplace, so much higher than the group average of 40%. Which helps us from a working capital perspective. It de-risks the business because we're not carrying all those inventory risks on the balance sheet. We've also really scaled up our services to brand partners. I mentioned H&M as a big strategic partner, but we have about 50 brand partners in the region that are using our operational services when it comes to fulfillment. And that's not as visible when we report NMV, but it is helping us amortize the cost base over a much bigger business than our own, B2C business effectively. What I think where we are clearly needing to improve and have to go further is broadly across two dimensions. So I think one is very much on the commercial side. We have an excellent assortment when you look at the brands that we're carrying on the platform. But I think we need to do a better job around really articulating that fully to the customer and at a more detailed level, tailor the offering to each of the relevant markets. So to make sure that the offering in Philippines is very distinct from the one in Indonesia, which is again very distinct from Malaysia, again distinct from Singapore, because in the end, these are quite different countries, different seasonalities, different trends, different major holiday events, etc. We've been very good in doing that on the marketing side, but we have further to go to do that also on the commercial side and really integrate that fully. And then the second piece, and I think this is something that we've broadly seen and learned across our business, is that as this industry is maturing, our customer base management just needs to get to a whole different level. It has shifted from a mainly new customer acquisition driven business to a customer retention, engagement, reactivation business. And we have done a lot of that work in the other regions successfully, but in Southeast Asia, I think we still need to really get there and fully also optimize our marketing to go after the most valuable customers. So it's not just about volume, it's ultimately about value. There's huge differences between a, infrequent, high discount seeking customer and a frequent new season, full price customer. And really distinguishing that and making sure that we cater to the highest value customer, not just the average customer, is another area of focus.
That's great, thank you. So there's been lots of things going on in each of the different regions. So could you just pull all that together and just give an overview of what you think have been the big changes that are going to improve the group's financial performance, and also talk about the medium-term financial guidance?
Yeah. So I think we're really at an interesting moment for the group because our guidance for this year is one where we expect that the top line still a range of outcome from a positive 5% to a negative 5%. And it's really partially the mix between the different performance in the different regions, but also quite uncertain outlook, more broadly from a macro, geopolitical, etc. perspective. So we've been cautious on the top line, but I think the one very strong commitment we've made is to deliver a break-even adjusted EBITDA for this year, which is an important milestone for us. We are getting to that through the mix of the actions we've taken in the last 12, 18, 24 months, bringing down the overall cost base substantially across the business in many areas, geographically, but also in terms of functions. We've really managed costs very, very strongly in all aspects of the business. And then secondly, seeing that recovery of the customer base and now being back in growth in Australia and New Zealand, as well as in Latin America, and therefore starting to see a little bit of operating leverage coming back into the business while really retaining that cost discipline. And so we're very comfortable with achieving that objective in 25. Then the next, I would say, medium-term milestone for us is clearly we believe we need to get about a 6% adjusted EBITDA margin to be sustainably cash flow break even or slightly positive. So from a profitability perspective, that's the next big milestone. And the way we want to get there over time is fundamentally one, scale. We do need scale, especially in markets where we are at below capacity when it comes to fulfillment centers and things like that. There's just fixed costs that are not being properly absorbed. So scale will help to some degree. Secondly, the continued shift into the marketplace business. We're currently at about 40%. I think we're going to move towards about 45%. That will help with a gross margin profile and therefore also the EBITDA profile. And then we think there's still plenty of efficiency wins across the deployment of technology. AI is playing a role in that, but it's not the only driver to then, move us from that basically break-even EBITDA in 25 to a 6% level, which then can also turn into break-even or slightly positive cash.
So, Christoph, that's great. I mean, you have lots of positives. Could we just talk about what do you think are the key risks to not achieving those financial goals, the competitor position?
Yes. Certainly there's risks. And in our business, I think one thing that we've learned over the last years, and I would say in particular the last 5 or 6 years have been very significant in that, is that there's always things that are in some way materializing that have an impact in the business. I think we have a very strong capability because we're so decentralized and local in our nature to pick up things very quickly and then also respond in a very agile and immediate way to what we're seeing, be it on the consumer, be it in terms of any political developments, be it on regulatory changes, etc. So we do see risks competitively. We do have an industry that is competitive. We do see some very large players, especially the general merchandisers and some of the global, very low price point, let's call it, players who are very aggressively marketing into our markets. So we are trying obviously to stay away from that by being more branded, a bit more premium and, much higher average order value than those players. But there is that pressure of a very low cost value offer to the customer. So we do see the competitive intensity, we do see the macro risks, and we certainly also see that we are in some geographies that are not always the most predictable in terms of policy making or macroeconomic events, although, these days it's kind of hard to tell. I wouldn't draw the line between developed and emerging economies anymore on that.
So we've tried to focus on all the long-term stuff, positioning of the business and the outlook, that kind of thing. It would be remiss of me not to ask you about the most important news flow over the last month of, the introduction of tariffs out of the US. Could you just give some insight into more on how it affects GFG and secondly, what are the other implications for your business in terms of the way you run it, in terms of opportunities and potential threats over the next 6 to 12 months?
Yeah, it's definitely the key headline. So for us, I think the most important thing is we don't have a direct exposure to the US in any shape or form, and our supply chain also doesn't flow through the US in any way that we can tell. And so from that perspective, I would say we're isolated from the direct impact of US tariffs or any counter tariffs to that. Where we do see an impact is at the indirect level, and I would really call out 2 things. One is on the supply side, where brands are responding to the realities of tariffs, and we may see flows of inventory into other geographies depending on what the tariff regime looks like. And obviously all of this is in flux. But I think anecdotally, what we're seeing is certainly that a lot of China-made stock in our industry that was earmarked for the US is now being rerouted, either held back or rerouted to other geographies. And I think that will include to some degree our geographies. Some of our geographies are fairly restrictive when it comes to imports. Brazil is an example, Indonesia is an example, where quotas and tariffs are quite restrictive. So we will see out some of that stock coming to our markets, and that will have an impact. Could make it more competitive with more supply being there, but it can also create opportunities for us having access to more or better stock at potentially more favorable terms. So I think the key for us is to manage this scenario in the right way, i.e. what we've done is de-risk our forward commitments, and really go into the conversation with the partners to understand what they're doing, what their expectations are for these markets, and kind of manage this in a partnership way. And then the second side is really demand. That's much harder to forecast. I think we have not seen any consistent data that would say there's been a demand shock or something like that in our markets to date. Now, I think this could happen if the tariffs are spilling over into a broader recessionary environment at a global level that then has secondary ripple effects into the economies that we are serving and operating in. But I think we are not coming from a place of consumer exuberance in any way. Generally, people have been fairly pessimistic already. Most of the indicators are more in negative territory than in positive territory when we look at Brazil with very high interest rates, or consumer sentiments in Indonesia or in Australia. So we're already coming from a place of caution. And so I would be, absent a major global recession or something like that, be still relatively confident that this is a manageable situation for us and we have the capabilities and are local enough to respond to it.
Well, Christoph, that was a great overview of the long term and the short term. So thank you for your time today.
Thanks for having me.